Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. Welcome to the Going Long podcast, where we're back once again to continue to help educate you so that you feel much more comfortable as well as confident investing beyond your backyard. I'm your host, Billy Keels. And if you ever wanted to know what it was like to have a specialization in architecture and then to be able to go on to create your own investment portfolio well in excess of $50 million, then this is the conversation that you're going to want to listen to until the very end. Because today's guest not only pursued architecture degree in the 1990s, but then he was able to use that in a number of very special projects that were anywhere from 40 units to 400 units. He also went on to create the SSSK Capital Fund, which invests in single-family residences, multifamily, retail, commercial, self-storage, as well as multi-use flex athletic facilities. We're going to have to hear about that as well. And he also likes the concept of going long and investing in different states. He's the principal of Coda Management Group Chicago, as well as Coda Design and Build. Welcome to the show, Scott Krone. Welcome to the show, Scott.
Thank you very much for having me. I appreciate the opportunity.
Hey, Scott, this is going to be awesome, man. I loved our pre-conversation, and I'm really excited for so many people to learn from you today. So as you know, we like to ask everybody kind of the same 5 questions. I'll hit you with 2 now, and then we'll hit 3 at the very end. But we're going to go ahead and get started. Hey, Scott, help us understand, where are you located in the United States?
Well, I'm in the city of Chicago. I just live north in a little suburb called Wilmette. It's up along the lake, just north of Northwestern University. But our company has expanded. We're doing projects in Wisconsin and Milwaukee. We have multiple projects here in Chicago. But then we have 2 in Ohio. So in Toledo and Dayton. I know you're from Columbus. So in your neighborhood. So halfway between Miami and both directions. Yep. And then we're going to be moving into Louisville, Kentucky now.
Love that. And we're going to talk about that expansion as well. This is something that's really, really awesome, especially for those of us that love investing beyond our backyards. So thanks for that. So fellow Midwesterner, today, I'm really looking forward to the conversation. And Scott, what is the most positive thing that's happened to you in the last 24 hours?
Well, a few things. One, my daughter applied to her favorite graduate program. So I got that news this morning. And
congratulations.
Thank you. But this past weekend, I got to watch an incredible documentary called A Most Beautiful Thing. And it's about guys here in Chicago. And so I was participating in a discussion about that last night, and I really enjoyed that. So just a wonderful story. It's a new movie that's out, also a book. And so I'm hoping to further that conversation with the people in the movie.
Oh, fantastic. Well, thanks for sharing that, Scott. So having a great impact from The Most Beautiful Thing. And I'll have to check that out as well, especially if it's made a positive impact on you. Scott, listen, I mentioned a couple of things, just some highlights as I introduced you, but love for you to share your backstory with the Going Long audience so we can get to know you a little bit better.
Absolutely. I come from 2 family offices, or not family offices, family businesses on both sides of my family. On my mother's side, we were a printing company that was based out of Denmark and Copenhagen. So that family was 5th generation, and they just recently sold their family business. It was 150 years old. Wow. And then on my father's side, we were in family business and die casting. And so I grew up in an entrepreneurial spirit in a family with both parents having experienced that, lived that. Seeing what it was taken to grow it during, the post World War II generation. And when I was at Kenyon, my parents showed up, my senior year for Parents Weekend. And they said, "What are you going to do next year?" And I figured I was going to go into the family business, like everybody else had done. And they told me that was not going to happen. And basically because they were selling the business. And that just completely rocked my world to learn that we were selling something that we had invested, not only, my dad's generation, but my grandfather's and great grandfather. And it had been around since, the 1900s. So it was a long-term family business. And that my father gave me the nudge to push back into architecture, which I had pursued in high school, and turned it down so I could play soccer at Kenyon. And so, I thought I'd close that door, but I found out that there was programs that allowed me to, with a bachelor's degree, to go in and get a master's in architecture. And so that's how I began pursuing, and that's how I got into real estate.
That is so being able to get into real estate that way, meaning that you were kind of looking forward to going towards the family business, and then to find out that wasn't going to move forward, right? So you talked about a little bit of the kind of the emotional thing that happened to you, that you weren't going to be able to move forward. But I guess kind of, I mean, when you're going through that, how in the world did you ever think, okay, I'm going to eventually start doing real estate, when you were at a point where it was probably really difficult?
Well, it's like life. I think it's about transformation. And for me, that's the key word for 2020 and 2021 is transformation. And so when I began pursuing, I got a month off between I graduated from college and when I had to start my graduate program. So there wasn't a whole lot of time to think about it. And so when I was beginning the first semester, which was in the middle of the summer, we're in this Mies van der Rohe building, and it's glass and it's hot and we're all sweating and we're drawing. And, you're just beginning to talk with other people about the different areas of architecture that we're all thinking of pursuing. Mm-hmm. And, it opened my mind to what other possibilities within the field of architecture. That next semester, I got into a TA-ship with my professor, who I ended up doing my master's thesis with, who owned a real estate development company, and he was an architect and a contractor. And so as his TA, he said to me, you owe me 20 hours. So you're going to work in my office for free. And I said, well, then I'm only going to work for free for 20 hours. And after that, you're going to have to start paying me. And so that was my first negotiations in real estate. And, being the only person that had an undergraduate outside of architecture, I could read and write, and I could, read a lot, because that's what we did at Kenyon, was read a lot and write a lot. So he had me working on the development side, and that really exposed me to the development side. So while in school, I was working on the architectural side, but in his office, I was doing all of the land acquisitions, contracts, homeowners associations, legal documents, loan documents, all those sorts of things. And so that's how I began running projects for him when I was still in graduate school.
I think that's fantastic. And just for those of you who maybe are outside of the U.S., a TA is a teacher's assistant, right? Which means
exactly.
that so he's working with the specific professor to help out. So that's great. And one of the questions I want to talk to you about later, we're going to come back to this experience in terms of development. But one of the things that you have really been able to find a niche in, right? I talked about, you've worked throughout a number of different asset classes, but you seem to really found a special place where you can add a lot of value, and something that is starting to become more and more known outside of the United States. But maybe if we could talk a little bit about this experience with self-storage. Tell us about that.
Well, self-storage is an American problem issue, if you will, that's growing across the world. We're spreading that. And, we're just a small piece of that spread. But it's a concept that as the value of land becomes too great and people in transition, or, there's really the D's of what motivate self-storage, and that's divorce, death, disposition, being transferred, a lot of different things. So for instance, when you moved to Europe, you may not have been ready to get rid of all your stuff in America. So you put it in self-storage, and then when you come back, it's there. Now you may have forgotten about it since you've been in Europe for so long, but for a lot of people that go abroad or do different things, it's a way of protecting and preserving their stuff. When they come back, they have it. The other side of it is, as real estate has gotten more and more expensive in the urban markets, it's more cost effective to rent a small space where you can put transitional type things in it. So for instance, during the winter, you can put your summer stuff in it. And during the summer, you can put your winter stuff in it. And so that's where we're really focusing on, is that market, is the urban market. And so what we're doing is we're taking underutilized buildings in urban markets that have been either not being used or underused, and we're repositioning them into self-storage. So we're taking these existing buildings, about 80 to 100,000 square feet, and we're converting them and filling them with self-storage lockers. And so what that means is people can literally drive into our building. The door comes down. They can open up their trunk. They can open up the sides of their car, the doors, the sliding doors, whatever they have. And they can safely move their stuff to their individual space, which has a locker and a lock on it. And it can be as small as 5 by 5 and as large as 10 by 20 or 10 by 30. So depending on what market they're in and how much stuff they have, they can rent different size lockers for their stuff.
Okay. So, and I want to make sure that we're understanding this, right? Because typically self-storage, some of us, we may have heard that, you've got a garage or a locker or something like that. But did I understand you to say that you actually figure out a way that the car can go into the facility? Maybe you could tell us, and I know you gave us some dimensions, but is this typically a building that it was an apartment complex? Was this a retail space before? Kind of help us to understand what type of physical structure was it? And maybe talk us through how you make that transformation, which was one of the words you used earlier, from what it was before to the now self-storage facility.
Yeah, every one of our buildings, you can literally drive into it. And so they've ranged. So, in Milwaukee, it was the first fireproof building, and it was a storage building before, but they used it for ballots and data files and literally rows and rows and rows of banker boxes full of files. Mm-hmm. Now within that market's gone because everything's digital, but people still have stuff. And so we've taken those things and we've literally make them, lockers inside the building. Both in Toledo and Dayton, they were, again, the Dayton building was absolutely empty for 40 years. And there's been a lot of regentrification and a lot of development around there. So there's a lot of townhomes and condominiums and apartments, and those don't have a lot of extra space for storage. And so that goes hand in hand with what we're doing. So a part of any urban regentrification and redevelopment, there's always an element of self-storage because the developers, are looking to maximize number of units. That doesn't mean they're maximizing the amount of storage within the unit. And so when a lot of people downsize, so if they're moving from their big home in the suburbs and they want a more urban lifestyle, they're moving into the city, but they have to downsize and, they still want to be able to have the Christmas tree or the ornaments and this sort of things and, put them in the storage locker while they're not being used.
Cool. So that's part of the process, right? Going from larger suburban to an urban location. Mm-hmm. And when you talk about kind of that process, if somebody is interested in understanding more about it, what are some of the things that I would want to look for to see, okay, not just to see if I want to put my things there, but as an investor, okay, well, yeah, I know that, how is space 1 better than space 2, better than space 3, for potentially looking to invest in something like that?
Well, keep in mind, as you mentioned briefly, I did come from the multifamily arena. So my master's professor and my thesis was a 400 unit development, which was $100 million in revenue. So it was 50 acres. We tore down the old Sara Lee factory. We, put in new roads, infrastructure, ponds, underground parking, condominiums, townhomes, single families, pools, all that sort of stuff. It's just a huge development. Mm-hmm. So for me, self-storage is a more simplified version of an apartment building because I've had apartment buildings, but I've sold them. Yep. It's basically apartments without toilets or tenants. So it's a beautiful thing. You don't have to worry about a running toilet or an overflowing sink or this or clogged that or whatever it is. It's just a much more simple and basic model. Mm-hmm. So it's also very demographically driven here in the United States.
Okay.
So
what do you mean by that?
Well, there's a predictability within it. So we can study a demographic within a very specific radius, 1, 3, and 5 mile radius. And that can tell us the predictability of not only the spending, but of what our absorption rate is going to be. So it's a very predictable model, but it's about 10% of what it is compared to multifamily.
Okay. And so 10%. So just on that really quickly, Scott, because you used a word there, so some people may not be familiar with. When you say absorption, what does that mean from a self-storage perspective?
It's the same for both self-storage and apartments. So if you're beginning with an empty building, how long will it take you to fill it up? So the absorption rate is each month, what percentage of buyers are you expecting to get? Perfect. So in an apartment building or self-storage is 3% per month. So it should take 3 years to fully fill it up. But if there's a great amount of demand, you'll be able to fill it up in like 24 months. And so what we're looking for is it's the demographic that we're studying is the square feet of lockers per capita. And so we can go into a market and see what the saturation level is. And if we're above that saturation, then we avoid it. If we're below that saturation mark, then that's a market that we're targeting. And so, for instance, when we were looking at our Milwaukee project, the first building that we saw was this 100,000 square foot building on 17 acres. We could have subdivided the property, put other buildings out there like restaurants or banks or whatever it was. It was a great building. It was a great location, except for the fact it was surrounded by single family homes and other self-storage. And so the saturation was too high. And so we didn't even consider it. We didn't even make an offer. The building that we did do, so in the Midwest, the saturation level is 7 square feet per capita, 7 square feet of lockers per capita. The one we chose in Milwaukee was like 2. So we knew that there was plenty of demand that we could fill within that market. So that's why we chose that neighborhood.
So there's some, I guess there's a lot, because this happens no matter what market you go into, right? But we talked about in the very beginning, you started in one geography and now you're clearly going beyond your backyard. You talked about Wisconsin, you talked about Ohio, you're now talking about Kentucky. What are some of the reasons, and you've started talking about it now, but traditional reasoning says, hey, stick around and invest where you can actually go and touch and see things every single day. Why make the decision to go beyond your backyard, to be in other geographies where you actually may have to get in the car and drive a couple hours or get on the plane or something like that?
Well, bigger is better, right?
There you go.
No, but I'm being facetious when I say that. The first thing is the scalability of the model. So when we were looking at the scalability of it, we were saying, okay, how can we develop a model and make it grow? So if we're growing in a market, it's hard to do it in a small area because of the fact that, one, we're competing against other product, but also two, we were looking at tax laws. We were looking at what are the more advantageous states. Where are the more advantageous situations? And so some of those things that we were considering don't necessarily apply just within Illinois or the Chicagoland market. For instance, historic tax credits. We've taken advantage of those in Wisconsin. The building had it. So that was one reason that it was attractive to us. Another one is a thing called opportunity zones, which is a powerful tool here in the United States, which was actually developed under the Obama administration, but put into law during the Trump administration, which basically wipe out capital gains. So if we can offer our investors a 30% reduction in their taxes, assuming that their tax rate is 30% for capital gains, that's a huge advantage for us. So we're looking for those markets. And then the other one is a program called PACE financing. And so we've looked for those different markets in those different areas in which we can take advantage of those areas. So not every area in Illinois has those opportunities, but not every state is also PACE. So we began looking for where are those markets that we can take best advantage of the investment tools that are around us.
So there's a number of things that you're talking about, right? Number one is really looking at taking a more holistic view, right? To make the opportunity to see where it will make the right opportunity that can create the greatest value. And you mentioned for your investors, which is something we love to hear, right? And you also talked about this is really a team approach, right? Because it's not just about saying this one particular property in this one particular area. It's how do you? I guess the question is really how do you work with the team to know that you're in the right market? Because I'm assuming there are thousands of MSAs. Like, how do you know to go to Kentucky versus going to Florida versus going somewhere else? Maybe you could talk to us about how you work with your team to figure out which are the right markets to study more.
That's a great question. And the first part of it is, why are we focusing on the Midwest? So let's just focus on the Midwest versus the rest of the country. Mm-hmm. Generally speaking, if we're going to make some broad generalizations, East Coast, South, and the West Coast are oversaturated with self-storage. So instead of 7 square feet per capita, they're at 9. Wow. So the level of competition is just much higher in those. So is it possible to find it? everything's possible, but is it probable? So then the fact is that if we're going to spend our time and energy, then we want to have a higher probability rate. So that's why we're focusing on the Midwest.
Okay.
So that's number one. The second thing is we're looking for middle market type products, which are underserved. And so we're looking for areas which are growing and developing. And over the past 20 years, Louisville has had an expansion rate that's like 20%. So just tremendous growth, and still projecting tremendous growth. So we were positive on that. So every community that we've been going into, we're seeing an upward trend of demographics. That's an important part of it. Then we begin focusing on, okay, is there a product in there? And then once we identify a building, then what are the bonus materials that we get for it? So is it in an opportunity zone? Can we get historic tax credits? Can we get PACE financing? So the one in Louisville, we can actually get all of those things. So it's in an opportunity zone. We can get historic tax credits. We can get PACE financing, but some of them contradict each other. So then we're going to be like, okay, which one is going to give our investors the most bang for their buck in terms of improving the capital stack? And so those are the criteria, but we're looking for size of the building. We're looking at a growing market. We're looking at, the buildings that we're buying them well below replacement cost. So the one in Dayton, Ohio, we bought 89,000 square feet for $1 million. Like I just can't build that size of building for $1 million. In Louisville, we haven't closed yet, so I can't tell you that price.
No problem.
But it's the same sort of thing. It's well below our replacement cost. So those are the things that gives us a competitive advantage going into a marketplace. That if we're going to have to build a new building, then compared to our competition, we can undercut our competition.
Okay, well that makes a lot of sense. And having clear criteria, looking at specific geography, looking at the specific type of asset, and having the focus on your investors, I think is fantastic. Now, earlier on, we mentioned something about development. You've just kind of teed it up for me here, so I'm really interested in understanding, because you talked about a specific asset that you couldn't build it for the same cost. And so I know there's something about underperforming assets in the self-storage facility space where it is a value add play. At the same time, I think I've heard people say that, there's actually a lot more opportunity in development. So maybe with your experience, you can help us understand like really where are the opportunities, and why could development potentially be more interesting for an investor or not?
It goes back to your goals. And the way we describe it is within self-storage, there's different asset classes, and we attribute them to different U.S. stock types. So there's the penny stocks, there's the blue chips, and the growth. Development is going to be the growth. And in real estate, so I started in 1991 when I began getting my master's degree in architecture. Every massive wealth changing, income producing has been through development. You can find opportunities to perform well within real estate, but you're not going to have the big growth unless you're changing the program of something. Mm-hmm. So inherently, let's just take a single family home. If you're going to put an addition on it, you're going to make it bigger. You're inherently changing the value because you're changing the program. So therefore, there's greater income, there's greater potential for that property. If you're taking an existing apartment building and all you're trying to do is improve the economic performance of it, you're going to have a margin. It's going to be limited by the capacity of that building. And so what we're looking for is how do we can change the use, whatever we do in development. So the better use we can make of the property, the higher the income, the greater the valuation of the building. And so that is my perspective as a developer, is how can I best utilize the building in order to maximize the income?
Love that explanation. And I don't know if you're watching us on the video or if you're running on your treadmill listening, but you should probably go back and listen to that, because Scott just gave a great explanation as to really making sure that you're optimizing the use of the particular space and the particular opportunity, whether developing or value adding. I think that was a wonderful explanation, Scott. So everybody, go listen to it again, because it was definitely massive value. So with that, I guess kind of a couple things. And we talked a little bit about the well, we've talked a lot about self-storage, and I know that there's something also too that you're really focused on is the whole concept of green. So maybe you could tell us a little bit about how that plays in to any type of either whether it be value add or it is a new development project that you're thinking about. How's that fit in?
Well, the fact that we are reutilizing a building is the first component of green. So instead of adding waste, tearing things down, we're able to repurpose a building. And we're also doing that in urban markets where the people don't have to travel as far. So those two things are inherently green. People don't necessarily see green and self-storage because well, then people have too much stuff. They should just get rid of it and throw it away or not buy it. Well, then that contributes to land waste, all those sorts of things. But rather than judging people's spending habits, what we're saying is we are repositioning a building and taking a building that is not performing or dark and making it back light, making it back a performing asset. And that was our whole argument with the city of Dayton. They were opposed to self-storage, but it was zoned for it, so they couldn't stop us. But that it really bothered them that we were putting a self-storage facility in the heart of downtown Dayton. And our point is, it's needed. People who are buying or moving into the city are needing it, and we're also making this building functional again. It's becoming not a liability, it's becoming an asset because it's contributing, it's helping to the community, and we're not having to tear it down. We're preserving that within the cityscape. And so some of the other things that we're doing is we're putting in brand new HVAC, we're putting in, lighting systems that are photo, emotion, and sensors, so everything's shutting down. And that's part of what we do with PACE financing. If we can show that we're improving the economic performance of the building, then all those energy conservation methods, we qualify for PACE financing. And that becomes part of the capital stack.
Which is great. You know what? And I appreciate you helping us understand, because once again, this is about finding a solution. You're keeping things intact, assets intact, and also helping different things that people like. They're not out on the street or in containers, but they're confined in a certain space. But you've talked about this concept of PACE, right? And it's one of the three things that you mentioned you could look to do to add more value for your investors. And maybe before we go into, I've got one more question for you, but you could tell us, just help us understand a little bit more about what is PACE and why is that can be beneficial for an investor potentially.
So opportunity zones were developed under the Treasury Department and Congress. PACE was developed under the Department of Energy. And so what they were trying to do is spur economic development and conservation through better performing buildings. So they say to any business owner, and in some cases a homeowner, if you are making energy improvements to a building and you can demonstrate that the performance of the energy savings is increasing, that money that you spend on that is qualified for PACE financing. And so what PACE is it's either through the government or a private bond fund. And it's a debt instrument that is rated at similar to a bond. So a very low interest rate, but it's applied to the real estate taxes. And so there's a special assessment to the real estate taxes that is amortized over the lifespan of the equipment. So we're putting on new roofs, new HVAC, new lighting. So those things typically have like a 20-year lifespan. So they amortize the cost over 20 years and they apply that over your real estate taxes. And therefore it's considered equity, not debt, because it's above the line item instead of being below the line item. And so therefore, if we're needing to raise 30% equity, we can fill like 10 or 15% of that with PACE financing. And therefore, we reduce our capital stack on the equity, which inherently increases our rate of return for our investors.
Fantastic. So you can do well and also be compensated for that. So I think these are some of the concepts. And be green. So this is another example of how you're thinking, how you're looking at it from a holistic team concept, and being able to also add another level of value for your investors, because there are definitely lots of investors that like to be part of green initiatives and also be able to see that in terms of a financial reward as well. So that makes a lot of sense. Scott, I guess before we kind of get ready to wrap things up, I would be interested if you we're in a really interesting time right now. Right. Yeah. And there's a lot that's happening. The world has kind of changed. We're not traveling as much. We're not doing a lot of things. And some people are predicting that, well, hey, listen, in a couple of days, weeks, months, it's going to be really, really challenging. So what is it that you're doing to be prepared to add more value to your investors and also to be prepared to well, see if there are opportunities to be ready to jump on them, similar to what you are already doing in Kentucky.
Well, we began this plan a couple of years back that we were going to have 10 assets in 5 years. And so the first thing that I've been through 4 major recessions here in the United States. And what I always saw was that, people not understanding the cycles, understanding what was happening in the economy. Now, obviously this last one, no one could predict based upon, nature, pandemic, whatever it would be. But in each of those cases, prior to that, there was definite economic signs. And so one of the major things is not over leveraging things, making sure that we have proper leveraging on them to withstand. The other thing is that we're buying appropriately. So we're not overpaying for an asset. So that way we can lower our cost in order to be effective to get our occupancy up, those sorts of things. So those are the 2 major things that we're doing on every single one, is we're making sure that we're buying right and we're not over leveraging them. And 2, we're sticking to our core foundations. The third thing that we're doing is that we're looking to expand about how we can improve our systems internally. And so just yesterday, we spent a good 3 hours just planning how we're going to do things differently. And personally, I'm embarking on a 2-year program for myself in terms of developing leadership skills. And so these are different programs that I'm doing, that our company's doing, and we're going to be breaking out new systems and new procedures in the beginning of Q1 of 2021, all in response to how we can continue to improve our company.
Fantastic. So really focused on the basics, knowing that you don't want to over leverage, knowing that you want to buy, that you want to be able to purchase right, stick to your core competency, and also being prepared. And I love the fact that you are leading from the front and focusing on leadership, because at the end of the day, strong leadership allows the organization to move in the right direction and have the right focus. So well done.
Thank you.
Look, Scott, I want to keep talking forever. That's just one of the things I do, and I'm enjoying this conversation. But at a certain point, the time is limited. So I'd love to get into the going long final 3. But the thing is, I never ask those questions unless you tell me that you're ready. So, Scott, are you ready?
I am ready.
All right. Awesome. So here you go. You were born ready. Look, you should come over and see us on the video. You can see Scott is definitely ready. So listen, first thing, you helped us understand where you are in the Chicago area. And I'd like to focus it back this way. And I know you have European roots, so that is awesome. So I'd love to know, what is your favorite European city, either that you visited, and I know you and your family have been over here a couple of times, or still on your bucket list to visit?
Well, I've been blessed to be going around a lot of Europe. There's always a sense of going home when I go to Copenhagen. So, Copenhagen's got to be on the list. Bucket list to see. I mean, my undergraduate was history, and there is so much history in Europe. And so, some of the things I do want to see are, obviously Italy. But I would also like to, explore different elements of, I've been to the Czech Republic. I've been up to Finland, Sweden, Belgium, all those things. But I haven't gotten to Spain. So I'd like to see Spain. I'd like to see Italy. I'd like to see the other parts of the historic nature of Europe. So all right. Those are some of the bucket lists. So
we're going to accept Copenhagen. We know that you have a lot of places, and when you're in Spain, you let me know or give me a heads up, and I'll make sure I'll show you around town in Barcelona.
That'd be great.
So Scott, the other thing is question number 2 or 4, if you're counting, is, anyone that's successful tends to make maybe 1 or 2 mistakes along the way. Only 1 or 2, I usually say. But no, probably a lot more. But if you can think of one specific kind of learning opportunity or mistake, whatever you want to call it, but most importantly, what lesson did you learn from that you would pay forward to someone else?
Well, I started my company when I was 28. So I've made more than 1 or 2 mistakes, and there have been blessings in it. And I think we do learn through growth, through success, but we also learn a lot through failure. And fortunately, I inherit's not the right word, but I fell into a mentor early on in my career that taught me a lot, that allowed me to start my company at 28. Mm. And that may have been ignorance or arrogance, or a combination of both, that thinking a 28-year-old can start a real estate company. But then I was blessed to have a mentor later on in life that has taught me more powerful fundamental tools about business. And he immigrated from Lebanon when he was 16. And now he's the president of Lazy Boy and Hype and Lazy Boy and Great Harvest Bread. And he's the president of High Point University in North Carolina. Just a wonderful man. And at first, I didn't think I needed a mentor. At first, I didn't think I needed a community. At first, I thought I could do it all by myself. And yet I realized through him the importance of having these things to expand in order to challenge you, grow you, to develop you. And it was because of that, that's where we've taken the company from a small local sub-regional part of Chicago into something across the Midwest now.
Wow. So I love that story, man. And being able to have mentorship and community, it is something that when you let go and actually fall into that, it can be a really, really powerful accelerator and growth opportunity. So thank you for sharing that, Scott, as well. And I guess kind of the almost last question is always interested in feeding our minds as well. So what book would you recommend to the Going Long audience?
Well, a powerful book that has changed how we've done business is The Road Back to You by Ian Morgan Krone. It's spelled differently, so I'm not getting any royalties. I'm not related to Ian Morgan. But it's given me a greater understanding of different personality types. That it breaks down everybody into 9 personality types and where we're healthy and not healthy. And it's helped me understand, relate, talk with people, communicate better, understand people, and more importantly, how I respond to those different things. Mm-hmm. And I'm really enjoying An Invitation to a Journey, which is about transformation. And so that's what we're going through now. And it's really setting up what we're going to be going through for the next 2 years.
Okay, awesome. So we're going to take the first one, which is The Road Back to You. But we now have the second one was Invitation to You.
Invitation to a Journey.
Oh, Invitation to a Journey was the second one. So here we go. Scott's over delivering everyone. So
I got a third one for you too. My son called me up from college. He's like, "Dad, you got to read this book immediately." It's called Extreme Ownership. It's by a former Navy SEAL. And so I'm going to be diving into that one.
Okay. So that's bonus coverage, everybody. If you're watching it, Scott's just giving it to you. It's all good. So, listen, Scott, you've just crushed it today. You've added so much value and you've been really, really helpful. From the very beginning, talking to us about having entrepreneurial blood in your family. Really, that's what you were looking for. You realized that was not going to be the case when your family told you that, listen, things were going to be changing. You then really dove head first and realized that, hey, listen, there's going to be some transformation. The path wasn't clear, but you allowed yourself to continue to move forward. You had lots of opportunities to experience things with your architectural background, managing really large $100 million projects with 400 units, things like that. And then you've been able to also carve out a very, very interesting niche for yourself in the self-storage space, and having a focus on your investors and really looking at how you can add value to them is one of the main reasons I'm sure that you are successful and will continue to move forward and continue to lead your team and your organization over the next 2 years. And I'm sure you will get to those, your goals well before that. And so I'm sure just the impact that you've had on me, there are so many people that are watching us on the video, that are listening to us when they're on treadmill or whatever they're doing. And I know they're thinking to themselves, how in the world can I get in touch with Scott? I want to talk to this guy. I want to find out more about him, his organization, different things that they're doing. And so would you do us a favor and please tell us what is the best way for everyone to get in touch with you and your team?
Well, I so appreciate that. Thank you very much, Billy. The best way is our website. It's www.coda, CODAMG, as in managementgroup.com. And you can do info@codamg.com if you want to reach out to us. And Billy, one more thing we'd like to give back to your listeners. I mean, obviously a European model, self-storage is developing there. So if people want to learn more about how this can apply in a European model, we'd be happy if they mention this show in the subject line of the email to us. We will jump on a call with them and describe what are the fundamentals that are necessary in the American culture to begin looking for what would be necessary in the European model.
Oh, that's fantastic.
It's a new and a developing thing. And one of the things we can give is a feasibility study that shows why self-storage works in the American market. So, if we're looking at, as real estate's becoming more and more expensive and housing's becoming more and more expensive in Europe and everywhere else, it might be a viable option. But Europeans generally tend to be a little bit more material conscientious than what we have in the United States, but it's a growing issue as the space becomes more and more valuable. So
Well,
we'd be happy to go through that with them.
All right. Well, really appreciate that. And so take Scott up on the offer and check him out at codamg.com or info@codamg.com as well. And we will also include that in the show notes. Make sure that you include in the title, as he mentioned before, so that you can connect with him and his team. So look, Scott, like I said, man, you've really added so much value. You've helped me a lot, and you are definitely helping the Going Long audience. So I really want to say thank you from the bottom of my heart for spending the time with us and helping to educate me and the Going Long audience. Thanks so much, Scott.
Thank you very much.
All right. Awesome. And so for the Going Long audience, once again, listen, Scott really brought it today. He's helping you to understand his background, more about the self-storage space, and he's even willing to get on a call to help those of you that really want to understand more about it. And he's talked about the feasibility test and helping you to understand about that. So, and because of that, look, I'm going to ask you at least go out and share the episode with 2 to 3 other people, because Scott really helped with so much today. And I want to say, you know what, as you let us know what you liked about the episode, what you want to hear more about, so we can share that with Scott and share it with me. And you know what, if you want to leave a 5-star review, you can feel free to do that as well. And I guess until then, and until the next episode, I'm really, really looking forward to welcoming you back. And I want to ask you to go out and make it a great day. And take care. Thanks a lot.
Wow, don't you love hearing from top-notch experts in the field? You know, when I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.